Welcome everybody to the ATU Ltd Pension Trust meeting. We'll call it to order here at 11 o'clock. We'll first start off with a roll call of trustees. So, Mr. John Gangle.
Here.
Michelle Weber.
Here.
Christina Hsu.
Here.
And Mark Johnson.
I'm here.
And Fred Casey. On his way over, I imagine. Okay, that's everyone. And then we'll move on to preliminary remarks from the chair. I don't have any preliminary remarks except to say to the audience who may be watching or anybody that's going to watch later, we'll be going into executive session soon. So just hold tight. We'll be back to our regular business after that. So after we have some discussion there, no decisions will be made in executive session, but we'll come out of that and we'll make a choice. Okay, so anybody have any announcements or additions to the agenda? I'll give a look around, see if anybody's got their hand up. Not seeing any hands up, so we'll move on to public comment. So first, I'll ask if there is anybody that wants to give public comment. I'll look for hands. If you do, please raise your hand. Not seeing any hands up for public comment, so I won't go through and read the instructions for public comment. We'll move on from there. And that actually takes us to our executive session. So with that, I'll read the script. The trustees of Lane Transit District and Amalgamated Transit Union Local 757 Pension Trust will now meet in executive session pursuant to ORS 192.6602F to consider information on records that are exempt by law from public inspection. Representative of the news media and designated staff shall be allowed to attend the executive session. All other members of the audience are asked to leave the room. Representatives of the news media are specifically directed not to report on any of the deliberations during the executive session, except to state the general subject of the session as previously announced. No decision may be made in executive session. The executive session is expected to last approximately 30 minutes. At the end of the executive session, we will return to open session. So I'll make a motion to enter executive session. I move to enter into executive session for the purpose just stated. Can I get a second?
I'll second it, Bill.
Thank you for that second. Any discussion? Nope. All in favor, signify by saying aye.
Aye. Aye.
Aye.
Aye.
Well, the ayes definitely have it. So I guess we have some work to do. We got to move over to the other meetings. I think there should have been another link in your inbox for that meeting. Leave this meeting, click on the executive session link. Camille will keep this meeting open and we'll return to this meeting. So all those in attendance, please be patient with us. We'll be back after our executive session. I'll see all the trustees and staff over in the executive session link. Nicole Burke starting November 2021. Can I get a second on that?
I'll second.
Seconded by Fred Casey. Any discussion on this motion? Give you a second. Not seeing any hands or anybody else indicating they want to speak on it, so we'll move for a vote. All those in favor, say aye.
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 All those not in favor? The ayes have it. Unanimous vote. Okay, so with that business done, thank you everybody for going through that with us. It was a good discussion and a good process, and I think we learned a couple things in there. All right, so the next thing on the agenda is the approval of meeting minutes from last meeting on February 15th. They were sent out as part of the agenda packet. If you've had a chance to read through them, entertain a motion to approve the meeting minutes.
So moved.
Moved by Mark.
Second.
Seconded
Second.
by Michelle. Thank you. Any discussion on those? Not seeing any. All those in favor say aye.
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 All those not in favor? All right, you guys have it. So it says items for board recommendation. We don't have any at this meeting, so we'll move on to the reporting the investment consultant, and we'll hand the keys over to Ian.
All right. Thank you, Bill.
Thanks for being patient, Ian.
Of course. Bill, if you could just give me a kind of heads up when that pops up.
It looks good to me. You're there.
All right. So I've got 3 items today, all for discussion. No action necessary unless the trustees feel is necessary. We'll start out with the performance report. We'll do our annual asset allocation review, and I've got a short memo on a PM change in one of the underlying strategies. So we'll start out here. I believe this is page 9 of the packet. Talk a little bit about capital markets through Q1. Generally was a fairly difficult quarter. I don't think this is one that surprised a lot of us, but probably some of the underlying fundamentals were fairly surprising in terms of the relation between equity and bond movements at the same time. I think that we've probably been telling you all for a number of years now that future returns are likely to be lower than the last decade, particularly, and a lot of that stems from some of the things that have happened since the GFC, really elevated valuations in the equity space, and in tandem, interest rates that have been driven down to zero essentially on the front end of the curve and very low on the back end of the curve, due to a number of dynamics that weren't made any easier during the COVID crisis in terms of the Fed pushing interest rates back down to zero on the front end of the curve and the back end of the curve kind of following suit. And so it's kind of left us in a pretty vulnerable position going forward. On top of that, we had some, pieces of the market that were gaining steam in terms of inflation. That was certainly not assisted by the Russian-Ukraine crisis that has further put pressure on energy prices and supply chains and further exacerbated already high inflation levels. So really there wasn't a whole lot of places to hide in terms of what had positive performance in Q1. Thankfully, we do have some exposure to that, and I can talk through that when we get into the performance report a bit in terms of some of the inflation hedging components in the portfolio. But traditional asset classes, equities across the board, both here in the U.S. and internationally, were pretty sharply down in Q1. And the more surprising aspect was how far down bonds, got priced down with increases in the yield curve during Q1. I will say that unfortunately things look, Q2 has not been very good thus far. We're into mid-May now, so we're halfway through Q2, and unfortunately the numbers look quite a bit worse than they do even here as of Q1. Same kind of trends have persisted. We've seen equities get pushed down even farther in terms of pricing. Certainly some differences depending on where you were in the market on public equities, but probably the more notable increases is how much yields have increased, not only on the front end of the curve, which the Fed controls, and we're up pretty high, off of a couple interest rate increases already this year. The Fed has signaled that it is willing and wanting to try to curb inflation. Their main tool to do that is increasing interest rates. Yet we're at levels right now that until the Fed can get us back up to much higher levels, we're probably going to be fighting the inflation paradigm for most of this year, I would anticipate, unless something happens to reopen supply chains to a greater degree. Obviously, like stated before, the Russian-Ukraine crisis isn't helping things. China going back into somewhat of a lockdown is not helping things. Essentially, we've got a lot of deglobalization forces at factor that are further suppressing supply chains and in a sense, further making inflationary pressures worse. So that's the unfortunate. A lot of negative news there. There's not a whole lot of great aspects to talk through in terms of Q1, and certainly not through Q2 thus far. But we can talk through some of those dynamics as we talk through the fund performance. I did think that this chart, this is a new one that we included in here for this year, was a fairly interesting one, and it kind of puts into context how abnormal 2022 has been. This is through Q1. But to put it in context, the Barclays Agg, or the Bloomberg US Agg as it's now called, it was down about 6% in Q1. And that is the third worst quarterly return on record for the US Agg. And then unfortunately, as you can see kind of highlighted here where we've got this in Q1 2022, a pretty large outlier. There's really only another two observations over history where both equities and fixed income sold off to that degree at the same time. You generally think of fixed income as having somewhat of a zero to negative correlation to equity markets, and so it provides your portfolio diversification when equity markets are selling off. But given some of the dynamics that I just mentioned in terms of where we are in the business cycle and where we are post-COVID in terms of the liquidity that the Fed initiated and suppressed yields down so far, we're in an unfortunate area right now where going forward, while equity valuations have reverted to some degree, certainly this year with how much they've sold off, we're in a place where interest rates are generally on the rise. And so that is an abnormal territory for markets. And it unfortunately, to my earlier point, did not provide a lot of places for investors to hide with both of their main engines in their portfolio, their diversification engine in their bond portfolio and their growth engine with equities, both being down strongly negative in Q1. And so this is just a chart that illustrates that relationship over the past, 30 or 40 years that shows how that is not a normal thing for markets to have happen at the same time, but we certainly did see it in Q1. And thus far in Q2, we've continued to see that to a large degree. To put that in context, through yesterday, I think the S&P 500 was now down about 16%. Today looks better, at least the last time I checked. But it's down about 16% this year. But the Bloomberg US Agg Bond Index is down 10% year to date. We saw the 10-year jump all the way up to 3.2 on Monday. It's back down sub 3 right now, but generally we're starting to see some places where the yield curve is starting to invert along the maturity scale. And that is, as we all know, a fairly strong precursor to recessionary indicators. When that happens, you know, it has a lot to do with how fast the Fed drives us there, and some of the other market dynamics that I've discussed. But to kind of put things in summary, you know, the yield curve in general is not forecasting very rosy conditions coming up. So that's generally the high and low of mostly lows, but of the quarter one for markets. So maybe I'll pause there. Happy to talk about anything market related as Q1 is concerned, and or anything that's happened through Q2 before we jump into actual performance.
Hey, Ian, on you know, you're saying the supply chains are at risk still with the COVID lockdowns in China and the Ukraine Russia crisis, but is there still pent up demand in the economy still coming out of the 2 years of COVID that are, you know, keeping things at bay, at least? Like, people can't spend on one thing, so they're spending on others.
Yeah, I think that, you know, demand, from what we've seen leading up into a couple months ago, you know, consumer demand was still really strong. It's tapered off a bit from different economic measures definitely over the past month. But I think, you know, we were in 7% inflation territory last year for a good chunk of the year before we started getting up into the 8.5 levels we are now. And a lot of that had to do with, I mean, you think of the supply and demand curve, you know, demand is increasing and supply is decreasing. I mean, that's just two really strong inflationary pressures happening at the same time. I think demand's been kind of curbed to a degree over the last couple months, certainly. You know, it tends to kind of follow the business cycle to some degree, and so we're seeing that happen a bit. But you're right, Bill. I mean, a lot of those inflationary pressures, I believe, they really started on the demand side. They really started on pent-up demand that was influenced by some of those federal stimuluses that were you know, passed out to individuals, but they were certainly kind of rolled onto in a lot larger degree lately due to supply chain constraints. And so while demand has backed off a bit, the supply chain bottlenecks certainly haven't. If anything, they've gotten worse over the last few months, and so we're left with inflationary pressures that have not abated to any large degree.
Yeah, I was just curious if demand was going to chase other sectors. You know, goods, yeah, those are getting more expensive, but services and travel may be receiving some of the pent-up demand that can't be satisfied elsewhere.
Yeah, I think you've seen that to some degree, certainly, you know, but it's not one where we've seen a kind of a large, we've seen shifts in demand. Service sector has certainly taken a lot of that from goods, but even in the services sector, you know, airline's an easy one to pick on. I mean, they've got their own issues with fuel shortages, fuel costs, personnel shortages, wage increases. So, I mean, there's a lot of places you can pick any sector, and they've got their own supply-demand dynamics that are further fueling inflation. And that's why, you know, inflation's a tricky one for the Fed to kind of grasp right now, because they've let it run to a degree where they're largely behind the curve. If you hear that kind of term, you know, thrown out there, where they probably could have curbed this sooner if they wanted to, but didn't, thinking that it was going to be more kind of transitory, and it certainly didn't pan out that well. Or that way, and I think that we're left in a spot that they're going to have to do some pretty aggressive tightening going forward to get inflation under control, and that's spooking the markets, because, you know, increases in you know, discount rates make future cash flows look a lot less valuable, and that's why we're seeing equity markets sell off the way they are. So I'll move a few more pages forward. We'll take a look here on page 19, where the portfolio sat at the end of Q1. You can see there at the bottom, about a $2 million loss over Q1, ending at about 39 million. You can see the asset classes there in the kind of the left-hand box here. Equities down somewhere between 5 and 7%, but really the surprise here is the fixed income component of the portfolio is down 5%. And recall, we don't even have a lot of credit risk in here in this portfolio. It's a lot of treasury exposure through that Vanguard total bond, and to lesser degree, but still prevalent within the double line portfolio. So, when you think of other clients' fixed income books that potentially have more credit exposure, being down only 5% was oddly not that bad for the fixed income book, but versus what I've seen in a lot of other clients. I think the thing that really helped us out here is the fact that we had almost 15% in the real return. Remember at last year's asset allocation exercise, we upped that exposure kind of in the face of continued inflation. And while that's going to be challenged to some degree to provide positive returns in perpetuity, given that we're going to see inflation start rolling off to some degree, I'm pretty glad that we upped that thing, down up to about 13%, and it's run a little bit over its target right now due to market movements. But, absent that real return portion in the portfolio, it's not that uncommon to have seen peers down, closer to 7-8% in Q1. So I know the -5 at the total fund level does not look fun. But generally, I'd say that's a portfolio that's held up reasonably well, absent some large real estate book or large private equity book that hasn't yet to be marked. So for a fairly liquid portfolio, this is actually held up fairly well during Q1. Maybe to put that in context a bit more, I'm going to skip around just a little bit and then I'll come back to some of this. But, here's a chart that shows versus your peers, your ranking in a floating bar chart. So you can see there, about at the 50th percentile, right around median. So beating half your peers, underperforming the other half your peers, although I'd note that you're much closer to the top of that floating bar chart than you are to the bottom of it. I also think an important note here is, we've talked about this before. This peer group is pension plans under 100 million. There are some portfolios that have a lot of fixed income and have hardly any equity exposure in there. And so those are some of the ones that fared a little bit better during Q1. But to my point earlier, fixed income was still negative during Q1. So you can see there, even the best performing peers really were still down, 2 to 3% in Q1. So it was a tough quarter for everyone. But it's not uncommon, like I said before, to be kind of closer to that -7, 8 range. Book pension plans that had a lot more equity exposure were certainly down there, and ones that didn't have any real return or any inflation hedging component were all the way at the bottom. So some of the decisions we've made in the past couple of years to right size that a bit certainly paid some pretty strong dividends here in Q1. I'm going to jump back a bit and maybe I'll kind of just go through. I'll start at this page 23. You can see there the total fund ranks at the top. We still rank really well over the 3, 5, 7, 10 years. We're right around top quartile versus peers. So well outpacing, even with a pretty brutal quarter. Still, I want to put this into context, and not get too hinged on 1-3 month activity. When we look over longer time periods, out to 10 years, we're well outpacing our investment return assumption. And so I don't want us to get caught too hard looking at current market dynamics, but keep the long picture in mind. Certainly looks good on a long-term basis. In terms of kind of the underlying composites, there's probably, you can see there the total equity slightly underperformed. A large part of that will be kind of an odd fund dynamic that I'll discuss here in a second. The fixed income book versus the benchmark held up relatively well. That's mainly due to double line being a lot shorter on duration than the benchmark, and having a lot less interest rate sensitivity. Having most of our exposure be there is certainly proven very strong as of late, and so I think that's going to be a trend that continues this year. Probably outperformance of our fixed income book versus the broad benchmark. And then you can see that real return component up about 3% during Q1. So that was obviously the one that contributed or didn't make our total fund performance a lot lower than maybe it could have. On the next page, I'll go through kind of maybe some of the high spots, some of the low spots in terms of the managers. Dodge & Cox stock was actually positive for the Q1. Value held up much better than growth in Q1. That's continued into Q2. And so, that's one that's done extremely well. On the flip side, our growth manager didn't hold up very well in Q1. They've got a lot more in this consumer discretionary, which got hit a little bit harder. Probably the interesting one, I think, that probably doesn't get much interest from most people, but it was surprising to not necessarily surprising, but one of quite interest is this passive component for the international stock piece being about 78 basis points below its benchmark. And that has entirely everything to do with the Russian-Ukraine crisis. In Q1, MSCI and all international benchmarking companies, they dropped Russia from the benchmark. And so any passive provider that was meant to track the benchmark essentially had to write any Russian exposure down to zero and hold it on their books at zero. And it created a fairly large tracking error, which you don't normally see in passive strategies. And that's probably that held true for a lot of international managers that had minimal but some Russian exposure that they had to hold at zero until they can offload that, which to this point is still a pretty illiquid market. And most of these fund managers can't get rid of any kind of Russian exposure until those markets open back up. So that was an interesting dynamic that probably had a little bit of a negative consequence on the total equity portfolio as well. Maybe I'll stop there. I know we've got two other items, and I know we're probably running a little late already. I'm happy to talk more on performance if there's any questions from the trustees, but I don't want to monopolize the time here. Anything else I can answer from trustees with respect to performance? Okay. Hearing none, I'm going to jump quite a bit farther ahead in the packet, excuse my jumping through here, to the next, here we go, to the next discussion point. So every year we go through our annual asset allocation exercise with updated capital market assumptions that we put together, and I'll kind of explain what that process is for maybe some of the new people around the table. Essentially, we've got a target allocation that we come together as a group here to try to set the long-term strategy for the portfolio in pursuant of its investment goals and cognizant of the risk that we need to take to get there. and we re-underwrite those with new capital market assumptions. And what are capital market assumptions? Well, capital market assumptions are our view of forward-looking returns for a whole host of underlying asset classes. We take those, we put those together into a quantitative model called a mean variance optimization, and we identify if any tweaks can potentially be made to the asset allocation in pursuant of either better returns or lower risk, but keeping in the combination of both of those in mind. We don't want to just simply stretch for return and add on tons of risk for marginal amounts of return. At the same point, we don't want to de-risk the portfolio in pursuance of less return if we're going to not be decreasing risk to a degree that's not in favor of pursuing the investment-related goals of the pension trust. So in the background section I have here, wanted to remind us all what we did last year. So last year we reorganized the equity portfolio slightly, and we took away some fixed income exposure and we added it to that diversified inflation strategies labeled real return in our portfolio, but essentially an inflation hedging component. First move, the U.S. equity to international equities, I still think, and we still believe with our capital market assumptions over the long term, and again, these are 10, 20-year forecasts, that makes a lot of sense. Valuations in the international space continue to look much better than the U.S. space, and until that reverts to some degree or has some kind of mean reversion, we think that's a prudent strategy for clients to take. Hasn't necessarily played out over the past few months with some of this Russian-Ukraine crisis, but we still think it's the prudent course to take long term. That fixed income to real return, we'll just call it that, over the past year, that has certainly borne a lot of fruit. That was a very good move. That has definitely already materialized, as I mentioned during the performance metrics section. So that is one that we think is also a pretty good starting point going forward. As we're likely to see inflation abate to some degree going forward, but it could be a meaningful amount of time, potentially 2 to 3 years even, before we get inflation back to the Fed's quote unquote stated target level of around 2%. In our view, it's likely to remain elevated for another couple of years unless the Fed is much more aggressive in their tightening than they've communicated thus far. So these are the capital market assumptions and the changes we made from the year prior, 2021 on the left, 2022 on the right. You can see U.S. equity, we brought down 25 basis points. Now, remind you, we published these at the beginning of the year, so doesn't necessarily take into market moves this year so far, but they're not market moves this year, while fairly dramatic, haven't been enough to reset valuations to a large degree. So we still think these are prudent moves. In the international equity space, about held it constant. In the fixed income spot or segment, we increased it by 50 basis points on the return, expected return, because we've talked about this before, but yields going up is bad for fixed income pricing. As you saw on the performance side of things, it's painful getting there, but having higher yields is a very good thing for fixed income returns going forward. So while it's painful getting there, having yields increase this much this quickly, it is a strong return indicator for pensions going forward if we can get yields back to some normalized level. That's almost a hard word to say anymore, normalized, because we've been at such suppressed yields for over a decade now. But if we can get fixed income markets up to, the Fed's talking about getting the federal funds rate back up to in the 2 to 3 range, if that means the 10-year and the 30-year at some point get somewhere back up into the 4, 5, 6% range, you can think of that like that's an opportunity to have forward-looking returns for your fixed income book maybe contributing 4, 5, 6% a year, as opposed to what we've been in for the past decade, where the fixed income component of the book has basically been giving us 1 or 2, maybe 3% a year, and all of the growth of pensions has to be reliant on equity portfolios. So it's a good thing for yields to increase. It just hurts getting there for fixed income pricing. And you can see there at the bottom, we increased our inflation assumption by 50 basis points as well. We think that the next couple of years is likely to be at a much higher level. But again, these are 20-year forecasts. And so us moving from 2 to 2.5 is actually a pretty big move in 1 year. If you do the math, you take those 20 years and you take it back and you say, okay, we think that what is that our view on the markets or for inflation for the next couple of years? That's actually a view of us thinking that inflation will be somewhere between 5 and 7% for the next 3 years before it reverts to something more normalized in the 2s. So while the 2022 assumption says 2.5% for inflation, the math to get us there is telling us that we think that inflation is probably going to run more 5 to 7 range for another couple of years before we get some string of a 10-year stretch of inflation in the 2s. So just to put that number into context. I'm not going to go through all of these slides. These give some background on our buildups of the underlying capital market assumptions. We also put out about 120-page white paper every year that's got every single assumption in the methodology in there. We spend a lot of time doing these, a couple months as a firm and sitting around the table debating these. So if anybody would like a copy of that, I'm happy to provide it. But these next couple slides just summarize some of those building block methodologies for things like equities and other asset classes, and to give you a sense of how we get to those forward-looking capital market assumptions. So these are what we put into the model, these assumptions right here. We map them to your current target on the far right there. And you can see that we would assume that this portfolio has an expected return of about 5.5% on an arithmetic basis. But really what you're caring about is that expected compound return, two lines below that bolded here. And that's what we think, taking into market volatility over the next 15 to 20 years, that this asset allocation can likely produce. And so when we plot that on an efficient frontier, and that's those 10 portfolios that were listed before, plotting here, we want to see this current target plotting right on top of the frontier or close to it. We continue to do that, or continue to see that, which means that we've got a well-diversified portfolio going forward. And you can debate where you sit on this efficient frontier, either higher or lower. But generally, we think that the asset allocation that the trust currently has in place is an efficient one, which is maximizing return for a unit of risk, but also being cognizant of the diversification needed within. So that's kind of to put these illustrations in context. I think this is probably the component that I wanted to really zero in on with everybody, because I know that there's been some discussion as of late related to the investment return assumption. And so while it is not my job to advise you on what the investment return assumption should be, obviously that's Scott and Milliman's job, and I will certainly not try to overstep any boundaries here. It is my job to help inform you all of the likelihood of your chosen target meeting that objective over the long term, and what the risks could pose if you were to manipulate or change that target. So again, these 1 through 10, those correspond to the 1 through 10 on that efficient frontier graph, representing different mixes of those asset classes to achieve either a higher level of return with a higher level of risk, or a lower level of expected return with a lower level of risk. Our current target, by our estimation, over the next 10 to 20 years, 10-year here, I've got these 10-year metrics. This is using a Monte Carlo simulation where we test tens of thousands of portfolios, and we look at the distribution and we say, where is the median outcome if we regress against return streams? Where does the median fall and where does the distribution bell fall around that? And you can see at the median over the 10 years, it's about 5.2%. And in the bottom here, what that translates to at your current investment return assumption at 5.75, that corresponds to, in our math, about a 44% chance of hitting that or achieving. So not quite 50%. You'd always probably like to see that closer to 50%, but not terribly far off. You could say, well, what would we need to do? There's a couple ways to ask these questions. You could say, well, what would we need to do to the portfolio to be able to get it closer to 50% chance of achieving that? Well, you could say, okay, hypothetically, portfolio 10 gets us a 49% chance. Is that a good trade-off? I would argue that's not a good trade-off, because portfolio 10 here, over the 10-year, you've got to look at the median return gets us to about 5.67. So again, closer to that 5.75 target, but it almost doubles our downside risk. So in the worst outcomes over a 10-year period, if we happen to, in that distribution, fall far to the left tail, we just had really terrible markets for the next 10 to 20 years, which is always in the realm of possibilities. Think of like a 2008 type scenario slapped in there somewhere in that 20-year projection period. That might get us down double on the downside risk. In my estimation, that's something that is not something that we would all want to stomach. And so you've got to look at these trade-offs from that way. The other way you look at it, and again, I don't want to overstep my boundaries, so I'll let Scott talk through this when he has his discussion piece, but is you change your investment return assumption and you say, okay, what's the likelihood of our portfolio achieving that? And I've listed out a number of other investment return assumptions here on the left, as we always do, but I also wanted to make sure that was prudent to do here, given that we've had recent conversations over that. By our estimation, getting you to be that 50% chance of hitting that is probably somewhere in the 5 to 5.25 range. Again, capital market assumptions are not meant, and setting your target asset allocation is not meant to change every year in pursuance of your assumed rate of return or your investment return assumption. But it's a good thing to kind of keep in mind that I would say that a lot of clients right now have some kind of gap between their investment return assumption and what their estimated return is on their investment portfolio. And so that's not something that's new to a lot of clients, or not new to you, but it's something to keep in mind when having these discussions, right? I mean, setting the investment return assumption is not as easy as just pulling it down every single year. It has meaningful implications on contributions and on the future liability stream of the system. So again, not my place to necessarily say if it's it needs to be changed, but I wanted to do the math for you here to give you an idea of what the current target would be, in our estimation, returning likely in the next 10 to 20 years if we were to see somewhat of a normalized market environment. And by our estimation, that's about a 44% chance of hitting that. So again, maybe I'll wrap up here. Last year, we made some changes that I think were moves that I still agree with. I think that those were impactful thus far this year, and I think that they're still going to be impactful going forward in terms of a more global equity portfolio and less reliance on fixed income until we get yields back up to a starting point that that we can hang our hat on a little bit more. And I still think that having that real return sized up for another year or two makes sense. So I would not recommend any asset allocation changes. And the rationale is outlined there, but generally what we just discussed. So a lot of discussion there. Trying to keep it as the summary level, but if there's any questions or you'd like me to dive deeper onto anything, I am more than happy to do that.
Appreciate you teeing that up, Ian, for our future discussions in this meeting. Yes, obviously this has been a years-long kind of track. We've been reducing our long-range assumptions on our investment return, and we always try to be a little ahead of the curve if we can. I as I've been to conferences over the time, I always find ourselves at the low end of investment return assumption, which in some ways is a really good thing, because that just means we're kind of beating everybody to where they should be. But we'll have that discussion with Milliman here soon. Anybody else have any comments for Ian?
Bill, if you don't mind, I might ask Ian a quick question on the prior slide, just to tee one thing up for later.
I bet.
Ian, could you speak for just a minute on the difference between the 5.2% median assumption you show on this slide versus the 4.93 kind of compound return you called out a slide or two before? Is that a function of sort of the time horizon of this Monte Carlo simulation, or something else about the way that you developed that?
Yeah, so there's always going to be a slight differential between the 4.9 compound return that you see on a couple slides before on the efficient frontier. That is a straight math equation. That is, what's the arithmetic return? What's the expected standard deviation? And there's a math equation to essentially say, over a 20-year time period, how do I get to a compound return? It's not a very functional way of getting there in terms of real-world scenarios, but it's the theoretical mathematical way to get there. The more realistic way, we think, is to do what's called Monte Carlo simulations, which is this chart. And this is taking the asset allocation of each of these underlying portfolios specific to the current target. It's saying, let's run 10,000 simulations and let's plot every single one of what we think are possible outcomes on a distribution. And then let's tell clients what returns correspond over a 10-year time period. So again, slight mismatch on the time period. But I think the bigger thing is if you ran this thing 10 times, you're going to get 10 different percentile spreads. They're all going to be very close. I mean, maybe we're getting 5.2 at the median one time, we're getting 5.18 the next time, but generally you're going to have a slightly different outcome every single time you run those 10,000 scenarios. But we think this is probably a more realistic way at mapping future outcomes by saying we're going to map 10,000 of them, and we do apply probably too much information, but a non-normal log stable distribution. So it has a fatter left tail, because we know that markets generally have fatter left tails than a normal distribution. We tend to hinge on the conservative side of things. But long story short, one's a function of math, one's a function of what we think is a more applicable real world scenario in terms of testing portfolios over 10,000 different iterations of what a return stream could be over that 10 years. And then there's a slight time mismatch. We generally think of the mathematical way as a more of a 15, 20-year assumption. And here I've got 10 years. So there's a few factors at bay there, but hopefully that answers it to a large degree.
That's great. All right. Thanks, Ian.
All right, Ian, I know you got one more item for discussion here.
Yep, I will be quick, Bill. This is, again, requires no action, but wanted you all to be aware of it. Long story short, one of the portfolio managers for the PIMCO real return product that we've got in there, one of the PMs is retiring. We went down to Newport Beach in California, met with the new members of the team there. PIMCO is a well-established shop. adding a couple big names to the existing co-portfolio managers that were already on the strategy. So without spending too much time on this memo, the long story short is after re-underwriting the strategy for clients, we're recommending no client action. We still think they have a deep bench of portfolio managers. And basically, this is more of an FYI than any kind of recommendation. Or our recommendation is to not do it.
Those are the easiest kind, Ian.
They are.
Okay, any discussion on that last memo from RVK? Any other discussion, Ian, for the good of the trust?
Not at this point, but I will be sticking around for the whole meeting.
All right, great. Okay, so then we'll move on to the report of the actuary, and we'll hand it off to you, Scott.
All right. Thanks, Bill. And thanks, Ian, for doing such a great job of teeing up one of the main discussion points here that we'll have today. So I will share my screen and let me know when you can see that.
That looks good.
All right, great. Adjust this so I can still see you guys. All right. Okay, so we have fairly short presentation today, but with an action item for the trustees. This is really a follow-on to our February discussion. We are, at this point, really ready to complete our January 1, 2022 evaluation, which sets the contribution rates for fiscal year end 2023 and 24. And we talked about this, Lacey and I did, at the February meeting with a letter we presented there, and we can refer back to that if it's helpful at any point for the discussion today. But just to summarize kind of the high-level themes out of that, we talked about how the beginning of year evaluation date results look more favorable than the prior evaluation 2 years before that because we had 2 good years of returns in the interim. Clearly, this is a snapshot at the start of the year. Ian's talked a lot about what's happened in the last few months, which does not affect our valuation. That is a snapshot date, but it's something to keep in mind, especially when we're talking about sort of what's to come with investment returns and what we might see when we measure this 2 years on. At that time, big focus was that just as RVK has shown with their asset allocation study and their capital market outlooks, whether you look at RVK's numbers or ones produced by our colleagues at Milliman who kind of look at the same thing, or surveys of broader results, what's called the Horizon survey we talked about, the message has been the same. The forward-looking return assumptions have come down for all the reasons Ian discussed on equity valuations, where interest rates were at the start of the year. And under the market assumptions that we showed, all of them showed a median expected return south of the 5.75 that was selected 2 years ago. So RVK's was at the 4.93 on the compound return basis, or 5.2 if you look at it more on the simulation approach. We had other results that Milliman's, depending on whether you look at the 10 or the 20 year, was a little south of 5 or closer to 5.5, 5.6. And the Horizon survey was somewhere in that same range. So kind of a range of results that are all, lower than the 5.75, but some of them, not terribly so. And so the one other assumption we did discuss at that time was the mortality assumption update, which is pretty routine, and we kind of built into all the assumptions all the results we'll talk about today. So since that February meeting, we were able to get final data from the district and from current Stokes and complete our valuation work. Came out the liabilities were slightly lower than what we had estimated in the preliminary results, which is a small gain in our terminology. And the active headcount was lower than sort of what we had built into at the start of the year or at the February meeting, just assuming sort of a level head count. It actually, when we got the final data, was a little bit lower, which you'll see here. And that means the projected hour assumption that we talked about in February, we would suggest using a lower assumption, even if the actual hours over next year or the next 2 years do revert back to something higher. For purposes of the valuation and the snapshot we do for that purpose, we need the hours to kind of speak to the head count we have to get the right cents per hour rate for the ongoing accruals. And so we'll show that here in a moment. But at the end of today, we do want to be able to get the board direction on the assumptions and methods so we can finalize the valuation and deliver to the district for the contribution rate for the upcoming fiscal year. Okay. A little bit of background on our valuation and sort of what it's based off of, especially since some trustees, I know this is the first time getting to walk through one of these cycles. Starting point is data, snapshot data of the ATU plan population here. Shown on slide 2 are kind of headcount split of the last 4 evaluations. And the yellow kind of top bar here is number of actives at the valuation date. The green is what we call vested, terminated, or transferred members, and vested terminated is they've left employment, covered employment under the plan, but haven't yet started drawing their benefit. And then the blue, the bottom bars here are retirees and beneficiaries. So comparing the far right, which is this current 2022 valuation, to the prior one 2 years ago, biggest changes that we've seen are what I already alluded to, is the headcount dropped from 240 to 213 actives. And on the flip side, retirees and beneficiaries have increased with some retirements over the last 2 years. Obviously drawn down with some deaths in that time too, but overall was a 21 person increase in that category. So in the valuation, we take that data, we take the plan provisions and all the assumptions that we use, and we project out a stream of payments for the whole plan. And so that's what's shown here on slide 3. Projected benefit payments for the population that is in the plan at the beginning of 2022. Again, these blue bars are the retirees and beneficiaries, so they start at right about 3 million and then run down over time as that group over time passes away. And it's replaced by new retirees who come from people who are currently either vested, terminated, or transfers, or active. So that's kind of what this is showing. Not shown on this graph are new hires in the future who will earn benefits and then stack on as sort of a fourth color here to go with. But that's kind of the mechanics of our valuation. Do all the work to project future benefit payments based on the assumptions of when people will retire, what benefits they'll earn, how long they live in retirement. And then once we have that stream, we can discount that back to a current liability, which we call the actuarial liability for purposes of measuring funded status and determining the contribution. So that's kind of the background on how we get to the results that then we tend to present for the valuation. So once we've done that, we've projected the liability, discounted back, and determined our actuarially accrued liability. We do this comparison shown here on slide 4, the funded status. And the first column, just as it was in February when we talked about this, that's really where we were at the prior valuation, so in 2020. And then we've got 4 different versions of the 2022 results. So first, essentially keeping all the assumptions from 2 years ago, except updating that sort of standard mortality update. So that's still at the 575 assumed return. If you can see my mouse here, the 575. And then we have 3 more sets of assumptions at dropping the assumed return a quarter basis, or quarter point, 25 basis points. So you can see what that does. First thing to note here, just as we discussed some in February, but as a reminder, the 2 years of good investment returns in 2020 and 2021 really did, greatly improve the funded ratio from 68% to 81% if we're measuring on kind of a like basis, still using the 575 assumed return. It's also worth noting we use a 3-year smooth value of assets for this purpose. So even that big increase we saw there, that's not fully reflecting all the gains that were accrued over this 2-year period on the asset side. We reflect that over 1/3 a year essentially. And that means that the actuarial value of asset, the smooth value of assets of 39.7 that we use for the valuation, is actually a little lower than what the market value was of 42 million at the start of the year. So connecting back to Ian's discussion, the losses that have been in the portfolio so far this year, if they were to continue through the end of 2022, or if even 2022 and 23 are a bad year, we're starting from already having some cushion from not having recognized all of the gains of the last 2 years. And that's the point of a smooth value of assets, is that you don't go up as fast in the good times and you don't come down as fast in the bad times. And it's a little smoother path for these actuarial measurements in the contribution determination, but you always are following the market value and getting back to it pretty quickly. But just so, you know, a little bit of perspective there that we did kind of bank and hold back some of those gains at the valuation date, which is good, you know, good to know when we're in a spot that we have had a rough quarter and a half so far. Okay. So with that said, working left to right across this table, you really see the effect of reducing the forward-looking assumed return that we use for the discount rate here. So that would mark up the accrued liability from a little under 49 million to each, you know, step down. If you move to 5.5% assumed return, bumps up the accrued liability, and it marks the funded ratio down to 79%, 77% if you go to 5.25%, and 76% if you drop all the way down to 5. There's nothing magic about quarter point changes. You can select something in between, but typically this trust has stayed on that. And, you know, the artificial precision of a 3.75 assumed rate is not typically the direction that we go. Any questions on this from the trustees before we get into kind of contribution implications? The only other thing I would say is that Ian did a really nice job of talking about sort of the balance between this assumption. I definitely agree with Ian. I don't think that, you know, the 5.75 or 5.5, whatever you select as an assumption and whatever you selected 2 years ago, I don't think the right way to look at this is let's talk to Ian about whatever we need to do to the portfolio to make that happen, right? Or to make that assumption still sort of justifiable. I think it is right to look at this, that you need to work with Ian like you do to have a right asset allocation that's a good mix of rate of the of risk and return that is appropriate for the plan. And then we want to set a realistic assumption for the assumed return. And we talked about this before, that ultimately what you assume here isn't what governs the long-term cost of the plan. What governs the long-term cost of the plan is what you actually do get. If we got to choose that, we could give you different advice. But right now we want to be having an assumption that's a good planning assumption for a long-term rate of return. And so so while the 5.75 is not so far north of some of the capital market assumptions that it's unreasonable, it would be certainly more conservative and more likely to have, you know, future gains rather than future losses if you mark that down a little closer to where Ian and other capital market outlooks are kind of indicating at this point. Okay, one more slide of numbers and then can kind of move into any discussion. But this is translating those same scenarios into contributions. So again, the first column is the prior valuation and sort of what the 2022 to 23 fiscal year contribution would look like if everything had just kind of rolled forward as expected from 2 years ago. And so that would have been a contribution as shown here in the bold, $3.35 per hour contribution plus the shortfall amortization of $2,044,000. As a reminder, the structure of this contribution is that two-part structure to recognize that there's both the cost of ongoing benefit accruals, which we put in terms of dollars and cents per hour. So that scales up or down depending on actual experience during the year, and more contributions come in if the population grows and there's more hours and vice versa. And the $2 million number here is the shortfall amortization. So reflecting the fact that the plan is not 100% funded yet and there's a gap to make there. That is done in terms of a dollar amount that then can convert into a monthly payment. And so that means that that shortfall, which is really not tied to specific hours and accruals in the current period, that can get paid regardless of whether hours come in greater or lower than expected. So that was a change made a couple of years ago by the trustees to sort of bifurcate that approach, and that's the what we think is a good sound funding policy here. Working out those two pieces together with what was the hours assumption in the prior valuation of 510,000 gives you an estimated total fiscal year end 23 contribution of about 3.75 million. For context, the calendar year contribution for 21 for this plan was about 3.6 million or so. So kind of a normal built-in increase. This is all structured so that we assume increases of 3% each year in the way that we determine these numbers. So moving on to the first set of assumptions on the 22 basis, the normal cost number goes up a little bit, but the shortfall comes down because the funded status is improved. And so work that out with 445,000 hours, which fits better with the current lower headcount at the snapshot date. And you see actually a reduced fiscal year end 23 contribution versus what we might have just guessed at 2 years ago, would have rolled forward to, so 3.3 million. So to sum up, I guess, on that, the 2 years of good investment returns put you in a better funded status, and that overall pushed down the expected contribution before you make any other changes to where you expect returns to be going forward. And then if you do consider a lower forward-looking assumed return, it kind of gives back part of that reduction in the contribution, but does so by getting to a more, conservative stance reflecting what future expectations beyond 1/1/2022 might look like. So that's the 5.5%. It makes the increase you see here. That kind of net comes out to between 3.4 and 3.5. Dropping it to 5.25 would produce an expected total dollar amount contribution of 3.57, and dropping it all the way down to 5 would be about 3.7 million. Pause there for any questions on what we're showing here or any aspects of it.
I gotta say, this is kind of an unusual conversation, Scott. Usually when we're talking about reducing our assumed return, we always see larger numbers in the contribution, but I guess that's just a factor because of the lower annual hours at this moment.
That's part of it, and part of it is that when we're comparing this way, these newer numbers, they're reflecting the good of the improved funded status, so that's reducing the shortfall amount. So you've kind of got you've got a gain from the last 2 years, and if you get more conservative on the assumption going forward, you're sacrificing part of that, but it's still in the bandwidth of sort of, you've lowered your contribution compared to where you expect it to be, and you can go part way back if you get sort of stepwise more conservative here.
Yeah, I just gotta say, I appreciate that change that we made a few years back when we split apart the unfunded liability from the ongoing benefits, because that could have really put us in a pickle with the reduced hours over the last 2 years. So that was a good call. But all these numbers, 5.5, 5.25, I'd be comfortable with either. So, I guess best advice from you two. Ian was showing a 5.2. You guys are comfortable somewhere in there. I'll take any conversation from the rest of the trustees.
Yeah, I agree, Bill, that I think it makes sense to definitely reduce the return given what the two things that we just saw. So, and like you said, it also doesn't have a huge financial impact given the returns that we had before. So I agree.
Yeah, I'd probably go with the 5.5 rather than the 5.25, but I could certainly live with either.
And Mark, I like to be an optimist too, so 5.5, that's okay with me. One other thing I think a lot of new trustees may not be familiar with is there is a little asterisk on the bottom of this page, but it was just kind of the change we made a few years back and assuming the benefit increases at 3% a year and building that into the funding. So when those increases do happen, they're not unexpected to the plan funding, like they had been in previous situations. So it's always good to plan ahead, and I just want to point that out that we are planning ahead on those things too. Fred or John, do you guys have any thoughts on where you'd like to go, or Michelle?
I think I'm in agreement with you on this one, Bill.
Yeah, I'm going to defer as well. I like 5.5.
Yeah.
5.5 works for me.
Okay, well, that seems well within the realm of reasonability. And like I said, I know we're a small plan, and that's probably what suppresses our ability to earn bigger returns and assume larger returns. But when we go to educational seminars and whatnot, most people that I've seen have been around 7, but they're also from mega plans, so they can get into some, different kinds of assets than we can. So 5.5 seems reasonable.
Right. No, I think that's a really good point, Bill, is that you do see, like NASRA is the organization that puts out and maintains an up-to-date assumption on this, that their median on that survey is 7%, but that is by its nature statewide plans that tend to be multi-billion dollars, and that has implications both in what they can be in and then economies of scale and stuff like that. But those, I'd say, smaller plans, we run through the same model, big plans or small plans, and typically the allocation of smaller plans is going to produce something that skews lower, and that's a lot of what you're seeing there. There are some systems that just haven't come through their cycle of updating yet, but fewer and fewer than there used to be. Most people have made changes in the last 2-4 years, and if they haven't, then they will be in the next 2.
Yeah, I'd probably echo Scott's that, we work with a lot of those mega big state plans, and while what you're saying is certainly true, Bill, that, they can access, private equity and venture capital and private real estate that they can potentially kick off a bit more than public markets are giving them. I'd echo Scott's comments that generally what we're seeing is that they are moving in the direction that you all have been moving in or are considered moving in. So I would say that the discussion you're having here is right in line with them. And I'd also probably say that, a good chunk of them would probably like to be able to move quicker than they've likely been able to, but run into certainly more, we'll just call it legislative issues to put it lightly. They run into a little bit more roadblocks in terms of their ability to lower that figure. So I think the conversation you're having here is prudent and well within the realm of reasonableness.
All right, thank you, Ian. So Scott, you want us to make a motion to set the rate?
Right. I think, and it looked like Jeff had a comment to make there too, but what I would say, if I hand this over to Jeff, is if we could just get direction, if 5.5% is the rate, give us direction for 5.5%, and sort of the mortality and hours assumptions built into what you just saw, and we can finalize the formal valuation report on that basis. But Jeff, did you have something to add first?
No, I don't.
Okay.
All right, well then I'll move a motion to set the assumed rate of return at 5.5% with the updated mortality tables and hours.
I'll give you a second.
I'll give it to Fred. Fred second. Okay, any discussion on that motion? All right, all in favor? Aye?
Aye.
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 All not in favor? Yeah, I have it.
Thank you. That's all I had for today. So thanks very much.
Thanks, Scott. I'm glad we were able to get through that. That was caused a lot less consternation than some of the times in the past. So thanks for making it easy. And Ian, I guess, too, we got to give him some thanks.
Yeah, give him credit where due. Yeah.
Report of the attorney. Jeff, it says you have nothing to report, but just thought we'd give you some time.
Still nothing.
Still nothing. Okay. All right, and then we move on to the report of the administrator.
Okay, just the expenses and retirees since the last meeting. If there are any questions on that, that was provided under separate email.
I didn't have any questions. Everything looked pretty normal to me. The retirees were the expected retirees I thought would show up. So unless anybody else has any questions on that information Sarah provided, we can.
I do know there was one question about the insurance. The insurance is billed, both plans have separate insurance policies. So I just want to make that clear that and they happen to come at different times. So one comes like in May and one comes in like December or January. So
yeah, I saw that from Chubb come through on bill.com and
yes.
Yeah, it's kind of a steep price for protecting ourselves, but I still think it's worth doing to have fiduciary liability insurance. So
right.
Signed off on that this morning.
Good.
Okay. Do you have cash flow?
I do. The cash flow, Dean had prepared the work paper itself. So if you have any questions on that, I can try and answer them, but pretty much he took our general ledger and he just compiled all the expenses and the distributions going out. We have an extra amount of money that we need to get into the investment account. So we're suggesting a transfer of about $750,000 to go to investments out of the checking account because we keep just building and we want to make some money off that money.
Absolutely. I know cash is a hedge, but maybe we would like to get it working for us a bit. So 750 was the amount they wanted moved over?
Yeah, because apparently it looks like right now we are at about 1.1 million in the checking account. We usually like to have 3 months, and the distribution amount right now is about $250,000. So that would be about $750,000. But we're also at a gain. Everything that's coming in is causing us to have this overflow of cash. And so giving away $750,000 and not having 3 months for a couple months is not, we don't believe that's going to be an issue because we are at a positive cash standpoint. We believe that we'll get at that 3 months here shortly.
Yeah, I do know we'll probably have some educational expenses coming up, but it won't be that dramatic in terms of pricing.
Yeah.
Okay.
Well, and you have some credits on that, so.
Okay.
Sarah, do you mind if I ask a quick question on that?
Absolutely.
Is that, can you remind me, is it literally sitting in cash in like a checking account, or is it, it's not earning anything?
Well, we are earning some interest off of it. I think around about let me see. I think it's right around $200 a month. So it's not earning.
It's probably it's just like it's normal checking account interest at a bank.
Yeah.
So I guess maybe where I'm going with this is, you certainly have a decision as trustees to, you could cycle that into the investment program. We could rebalance kind of back to target, if you will. I think under normal market conditions, I'd probably be almost always in favor of that. I think right now is probably one of the times where you could you could argue it either way. It's not earning much in that cash account, but it is positive. We're probably at a time when the Fed's signaled further increases in the federal funds rate, which is positive on checking interest. It'll probably continue to go up. Not a lot, but, let's say federal funds rate is closer to, 1 now than it has been in a long time. And if they get a couple more interest rate increases here in the next few months, quarter or so, that could be more than 1. And I'm not one to necessarily to call anything on the markets. Markets have been pretty brutal right now, but that doesn't mean that they can't turn around really quickly. But I would say that, the decision on whether to move it over or not is probably not as clear as it sometimes is. So maybe I would probably just put that out as a discussion piece, that it's, you look at over what's happened over the last 5 months in the markets, the only thing that's been positive is checking accounts and anything tied to inflation. So just something to consider.
Well,
and to give the trustees an idea, we earned in April, we earned $187.81 on the $1.2 million balance.
Sarah, what's the positive monthly cash flow on that?
I don't know.
Ian, can I say, this may be a silly question, but I know for people, like individuals, we can do like I-bonds and things like that earn a high interest rate. Is that something that we could, are there things that can be done that are similar for this kind of situation where you put it in and it can earn a very high rate for a certain period of time?
You can. I would say that, I'm not entirely 100% sure if a public entity such as yourself can invest it in necessarily an I-bond.
Mm-hmm.
So and generally there's limits to the amount that you can as an individual put in those in a given year. So
Mm-hmm.
I don't know if that applies to public entities such as yourself. I could certainly look into it. You've got a lot of inflation hedging or things that are tied to inflationary levels in that PIMCO real return product.
Mm-hmm.
That would generally be more of a tactical short-term call than it would be kind of a long-term strategic call, which is definitely a deviation from, where we've generally kind of rebalanced portfolios to here, but it's certainly of possibility. I don't know if that's something that the trustees are open to considering or not, but it's something I could look into, certainly.
Well, it may not be that, but maybe something similar where it's like where that, because that one's currently in the 9+% range. And so I was wondering if there are similar kinds of instruments that are tied like that to the inflation, such that they have a really high rate of return right now. That's open to other than individuals type thing. And I don't really know all the instruments that are out there.
Yeah, I mean, the other thing that I don't know, I'd almost maybe bring Jeff into this conversation is, it probably is somewhat of a deviation from your policy, your investment policy, which kind of outlines the investments that are available to the trust. Now, that's not to say that document can't be amended, but I think I'd probably be more comfortable just staying with what the policy outlines and saying that so you don't have anything that comes back to you down the road that says, well, you all made a decision that was well outside of your policy and that didn't work out. So I think I'd probably think that your main options are you leave it in cash, you reinvest it in the investment portfolio, given the current investment options as outlined by your policy would probably be the most prudent discussions or the prudent decisions. But Jeff, maybe I'd defer to you a little bit on your thoughts on that decision-making process, like kind of a tactical one versus strategic one, if you will.
I mean, in general, I think that the key thing is that the trustees act prudently, and the funding policy was the overarching determination of what was determined to be prudent, but not necessarily in this exact, economic context. And so I think that if the trustees are reluctant to transfer the money, some money back to the trust because it's expected in the next few months that transfer might result in loss of loss of principal, then it may be prudent to either leave it in cash or to make a one-time decision to invest it, say, in the real return. It can also be tied to, I don't know what the frequency of transfers from the trust to this account in order to pay benefits is, but leaving that money, leaving more money than you had talked about before, because it won't lose money, and then maybe transferring less money in the future. The long and short of it is that if the trustees make a prudent decision based on a prudent process, then they can do what they want, notwithstanding what the funding policy says.
And it's something we can always go over in the next meeting. We can just bring it up again and look at how the investments are doing. And, as long as you guys know that money's there.
Well, yeah, and if we just stay as status quo, I don't think there's anything that would preclude us from making a decision interim between this meeting and the next trust meeting. If we needed to, for some reason, invest that to transfer and invest it, we can always call an emergency meeting and do that. Or could another option be just not playing the timing game, but transfer it over time to draw it down, so we're not affected so much by market timing?
Yeah, well, that's what I would probably suggest we do here, regardless of, if the decision was to rebalance into the investment account, unless directed by the trustees, I think the policy is pretty well outlines that you'd want to rebalance closer to target, not farther away from it. So, I think the decision more hinges on, is it something that you feel comfortable doing right now versus waiting on? This is more just of a gut feeling than anything. I think I'd probably be more in favor of delaying the decision and or doing it piecemeal, kind of between now and the next meeting, than transferring the entire. Did you mention it was 750, Sarah? So the entire 750 over, quickly, like in two big increments. Again, that's more of a just gut feeling on. I don't see a lot of positive things developing in the market in the short term. So, and even, that real return fund, like it's going to have months, like I said, that are not going to be positive I think actually even this month it's been down a little bit, not nearly equities or fixed income down, but been down to some degree this month, given that we're likely to see inflationary pressure start to roll over to some degree. So again, it's another course of action is exploring more high yield savings accounts to put it in your checking. With the bank, most banks offer some kind of high yield checking account that is very, very low risk and isn't just sitting in a money market fund, but is sitting in something that maybe stretches the duration out a little bit there too. So that's another option that I don't know if we've explored that or not, but it's one that Sarah might be able to ask the bank that's currently holding the funds to see, hey, do you have anything that's yielding, closer to 1 or 2% and still keeps duration very low, so you're not having to lock that money up for any period of time. But again, there's options out there. I just think that if the decision was, do we make the decision to transfer the 750 over right now, or do we wait until the next meeting? I think my gut would tell me to say let's wait till next meeting.
Okay, well, with your gut and advice, I'm comfortable staying where we're at. Maybe Sarah can research better checking account options like ICSs or whatever might be out there in the world for us to put our money in. We could report back at the next meeting then.
I definitely will do that.
And if anybody has a solution that they would like to see explored, you could say it now or email it to the trustees and Sarah later. Open to ideas.
Absolutely.
One thing I wasn't clear about on the amounts, it sounded like the idea is to keep 750 in the account, and the account's 1.1 million or something, so it would be a transfer of 400,000. Is that right, or did I misunderstand?
Well, the way he did it, he just he took the general ledger. So technically, at the end of April, we had 2.1 million in the account, and then we had some expenses that went out shortly thereafter, but that was right around that. So there's like 1.1 million in there. So it would be a $750,000 transfer that we would suggest. So we'd have a little under 750 left in there.
Okay, so I guess we'll defer further discussion on that till the next meeting, and we'll move to the next item on the agenda, which looks like an International Foundation invoice.
Yeah, Christina had sent me the International Foundation invoice. She wanted to have some discussion regarding the who does what on what plan. So I believe that the ATU made it mandatory for people sitting on the trust to become certified and go to this.
Trustee training is mandatory on the ATU plan.
Okay, yes.
And by happenstance or circumstance, all administrative trustees happen to also be on the ATU plan. So by proxy, they all get trained as well. It's kind of like a gift, not expenses to the admin plan.
Right.
Yeah.
So Christina, was there anything else that you needed to discuss about this?
Just that there's $1,000 credit for us to use towards the training that we have. So as people are deciding their training, we need to make sure that we're applying that credit towards their education. And I assume that that maybe it should be managed through the invoices going forward through Current Stokes instead of before they were being sent actually here. So it seems like it should go through the regular administrative process.
Sure, we can do that. That's not a problem at all. Should
And what are the dates of the next training? Do we know?
So it's in September. It was in the next International Foundation annual conference. There is a new Trustees Core Concepts training for folks newly on the plan in June, late June in Seattle. It's pretty much just like a, hey, you're a trustee now. Here's what you have to do. But that course is also taught at the annual. So you could just knock it all out at the annual. And I think that's this time it's in Las Vegas. So it's usually a pretty short trip, and usually Las Vegas ends up being our cheapest annual on the cycle. So probably just we can hold station until September on that, and we can figure out who needs to go to new trustees. I wouldn't necessarily recommend CAP training for people in their first year of being a new trustee. Maybe go to a few trust meetings, get the new trustee orientation, attend a few classes, and maybe in a year from now we could talk about getting your certificate in public plan policy. Don't want to overwhelm anybody on the first trip. But we do have quite a few people that we need to send as new trustees. So, and a new administrator. So Perry Adams, I would recommend also getting trained in September. So we should definitely put our heads together and try to come up with a schedule for that.
Well, and who usually, was it LTD that usually scheduled all that for you? Is that, and so.
Yeah, LTD HR generally did all the signups and travel and per diems and whatnot, and those were counted as direct reimbursables, and they were charged to the plan after the fact.
Okay, and do we know if that's the way it's still going to be?
I don't control those mechanisms.
Okay.
But it worked.
I guess Perry,
most likely it will.
Okay.
I'm
Okay,
assuming
good.
though, Sarah, that, I mean, it could be, if they have an invoice process, it could actually be billed just like we do with all the other bills as well, right? Paid through bill.com. That would also work.
Yes,
right? So,
absolutely.
I don't see what, yeah.
I can send all the trustees and the administration, Hillary and Perry, email that has the Lane Transit District's, it's like Lane Transit District pension at bill.com, and you just send a blank email with the attached invoice, and it comes in. I get a notification. I go in and I put in who needs to look at it. Perry's always going to be the first one. Then they're, depending on if it's ATU or salaried, it's going to go Bill and then Christina and then Mark and then Christina. And then once everybody has approved it, our main partner, Haley, is the one that just hits the go to pay the bill. So, and it gets taken out of the appropriate account, because when I'm reviewing it, I make sure I note to her what account to take it out of, because it's kind of, we've combined the two. So we have two separate bank accounts in one. So it's fun, but it's good. It just comes through, and it's, if you have any questions, if you haven't been through it yet, we can always take a look at it.
I think that might be simpler this time going forward.
Yeah.
I had one question though, Bill. What are the rules with regards to existing trustees? Are we? Because I attended once, but if there's a policy, what is the policy for existing trustees with regards to training?
Yeah, it was annual trustee education, so ongoing trustee education was part of it as well. It wasn't just CAP was a goal for everyone to get to, but ongoing refresher training is also part of it. Yeah, so you should be going.
Okay, thank you.
Bill, I just
Yes,
wanted
okay.
to interject. I was double checking the dates. I think it falls in October this year. It looks like 23rd to 26th. So
Okay, it's a late one.
yeah.
Sounds like I need to talk with Sarah and Bill about setting up the training. Is there anyone else that maybe we should add to that conversation? Okay, I will work on it. I think HR should own it, along with everything else that seems to be happening on this planet. So, we.
And Perry, I'm available anytime, pretty much.
Okay.
And in this world, Perry, we call you a pension administrator. So this is just something that we throw on the administrator, not necessarily HR. Just the hat you're wearing at the time, you're an administrator hat right at the moment. We always got to learn what hat we are at the moment.
Yes, indeed. So I will get something on the calendar for the three of us, it sounds like.
Perfect. And then lastly, it looks like the only other I just wanted to go over, because I've had a lot of people who are looking to retire contact me because they're just told to contact me, but that never really happened before. So I just wanted to kind of get all on the same page of if the initial contact, if it even matters, if the initial contact comes from me, comes from you, usually because they're employees, they usually go to you guys, but I don't know why somehow they've been contacting me and I've just kind of been sending them back to you guys.
I think now that we have some certainty in our structure at Lane Transit, it should most likely be housed with, I'm going to guess Hillary, but that's up to Perry. But yeah, I think we should definitely refocus that.
Okay.
Yeah,
It should definitely come to us first.
Yes, it should come to us first.
Okay. Perfect. I just wanted to get clarification from everybody. And that's everything I pretty much had.
Okay, so thank you for that. We'll move on to new and unfinished business. We have some standing items, COLA updates. Again, I'll just go through my usual refrain. We haven't met on this. We have a lot of new players. We're actually, this whole updates process was part of bargaining now 5 years ago. So we'll be back into bargaining anyway. Those are different hats. We'll talk about it then, I'm sure. And I think hopefully we can just kind of reset what expectations are and bring Scott and the reasonable players in to give us some real information on what the cost may be. So we'll reach out to that outside of this process. Okay. And then we talked about training. So we'll work with Perry and Sarah on pension trustee training. And meeting recordings. I see here this may be something that was thrown on by Camille.
I think it was a little of both of us.
Yeah, okay.
Camille and I were talking because we're still doing the handwritten meeting minutes, but she does all the recording and stores it. So we're kind of double dipping, doing both of those things. And she was under the impression the video is okay for the public meeting. Am I saying that right, Camille?
Yes. Yes. So let me make sure you guys can hear me. I've been having headset challenges. Perfect. Yeah. So for all of the district's other public meetings, we stopped doing minutes, physical minutes, almost 2 years ago, just around 2 years ago, coincidentally along the same time frames when COVID hit. And because of the records management system that we have, which is DoD certified through the state of Oregon, we are allowed to maintain electronic records of our public meetings only, so long as we store them within that records management system. So additionally, with broadcasting our public meetings, we have the audio and the video record as well. So we wanted to just see how the committee felt about eliminating minutes and maintaining the same process that for the meeting record as we do for all of our other public meetings, or if the preference was to continue handwritten minutes in addition for electronic record.
Well, I'll start. Call me old-fashioned. I like the handwritten minutes. they're easier for me to quickly review than watching meetings. If my duty was to approve last meeting, to go back and watch the meeting, I mean, yeah, I guess we could do that. But I'll just give an example.
No, there's no approval necessary.
Okay. I'll just give an example why I like the written minutes. And let's see here. And this is, I'll go back to 2012. And it was minutes, and when we talk about whether meetings are public or not and what needs to be a public meeting law, it was presented by LTD's counsel at the time that the ATU LTD trusts were not actually subject to the public meeting law. And so whether or not that changes, I mean, I'm fine with doing public meetings, but, I'm not going to be a trustee into perpetuity, and many people will change, seats over time. I would like to have something to refer back to and having our process as minutes. So Casey Huffman, I guess, was our LTD counsel at the time, and our pension attorney at the time also concurred. Everett Moreland, who was Jeff's predecessor. There was a memorandum at the time, but I can't seem to find it, but I found it in the minutes, which was great to look into. So I like having written minutes. But I'll take comment from anybody.
So would you mind sending me a copy of those minutes?
Yeah, I work with Sarah.
I can give you access too.
Yeah, I worked with Sarah on getting into all of our old records. She was very generous with her time that day to get me into the program. But I found those minutes 2012, February. So
Camille, I can get you access into there.
Okay, great. And just for additional reference, sorry, Jeff, the structure that I have for our public meetings now with broadcasting and live streaming through Metro TV with LCOG is the agendas are linked in the video that is maintained. So you can click on an agenda item and jump to that conversation point without having to go through the entire recording. I neglected to mention that piece. Jeff, please go ahead.
Is that me?
Yes.
You, Jeff.
I guess I second what Bill said. The time horizon on these plans is long, and decisions from years ago can pop up, and you need to refer to them. I don't know that, for example, it's important to for Sarah to draft a detailed description of what Ian says about the state of the economy and the investments in the prior quarter every time. Maybe just some reference to, there was discussion about the status of the investments in the economy or something is good enough for those items. And if somebody wants to know what was said, what Ian said, generally they can go back to the recording. But I think that any decision by the trustees should be recorded in minutes so that they can be easily retrieved in a way that, you just can't where what you have is a video link. So, if we need to know what was said, 10 years ago about some particular legal issue, being able to go back and listen to all the meetings within a 5-year period in order to figure out which meeting it was that this was discussed is just not anywhere near as useful as doing a word search on the minutes. So I would advocate, at least for the decisions, to be recorded in written minutes.
Thank you, Jeff. Anybody else have passionate about minutes?
Well, yeah, and I think what Camille said is you don't have to go back and look at it all. You can click on the agenda item and it goes directly to, to the place, and you can keep 5 years or 10 years of records. I mean, it's all in order. So, maybe we just keep what we're doing for now, and maybe we have an example of what that looks like going forward and get people more comfortable with it.
I agree, Mark.
Okay. I guess status quo for now. Thank you, Camille. I do love the video format because I do like to share it with my members, the work that we do on their behalf. It's not just all fun and games sometimes, it's really business. And we're looking out for their best interests and their retirement. So the videos have been eminently useful in that capacity.
Good. It has proved very useful and very valuable in a lot of ways. I can certainly understand where you're coming from, though. It is a change.
Yeah, sometimes we struggle with that too. Okay, so anybody else have any new or unfinished business? That's all I had, and that's all the agenda had. So I'll leave it to you. Otherwise, we'll bid you adieu.
Thanks, everyone.
All right. Well, that concludes the LTD ATU Pension Trust meeting on the 10th of May.
Do we need to set a date for the next meeting?
Oh, yeah, we should.
Oh, and I wanted to bring up one other. Sorry, go ahead, Camille.
Hi, Christina. Go ahead. I just wanted to make sure Perry and Hillary knew that this ATU side is ending, but we're going to be starting the other side. So the meeting is not truly over.
The admin plan still.
Yep.
I made that mistake in the beginning, and I thought it was the end of the entire thing, and it was not.
And Bill, I just wanted to give you a heads up that at the next meeting for both the ATU and the salary plan, I'm updating the board policy, and so I will bring probably that updated policy to this committee as well to see.
Okay,
in light of the strategic business plan and stuff like that.
We'll make sure that's on the agenda then.
Thank you.
Date and time. So we usually go to Ian and his sense of timing of reporting. So what do you think, Ian?
And I apologize if I missed this, but is the virtual or in person, has that been discussed, or are we just assuming virtual until otherwise told?
I mean, frankly, I'd love to get back in person. You know, that would be my vote, to be in person for the next one.
Yeah, so our board just made the decision at this past month board meeting to begin hybrid in-person and virtual public meetings, beginning with the June regular board meeting. So after the June regular board meeting, all meetings will be hybrid and in-person. There will always be a virtual attendance option, but we are encouraging in-person as well.
Great. So let's keep in person when we're thinking scheduling wise.
And we usually go in August, just to give everybody an idea.
Yeah, I was going to say that generally, I think the week of August 8th would be probably the soonest, Bill, in terms of having all the data ready, but certainly could do the next week, the 15th as well. So I think those are probably maybe our target areas, unless people have conflicts.
I'm good either week.
August 15th works for me. The 8th does not.
That's a Monday. Do people really want to do it on a Monday, or we could do it on the Tuesday?
I meant the week of 8th.
Okay.
So yeah.
Okay. So yeah, the 16th or 17th are pretty good for me. 11 was the start time we've been using. Does anybody have any conflicts there?
17th is the only day I've got, Bill.
Okay. The 17th we're down to. Any takers on the 17th?
The 17th works for me, Bill.
That works for me.
Me as well.
Me too.
That was very positive.
Wednesdays generally aren't good for me, but
Does an afternoon or a morning make a difference for you, Michelle?
no, Wednesdays are just, that's the day my calendar is completely full. with work meetings and that kind of thing. So.
For reference, we also have our regular board meeting on that particular Wednesday beginning at 4:30.
Well, does Thursday the 18th work for people?
I hate to be the one that does it, but I can't do the 18th. I have another meeting that day. Apologies.
Same
I can
with
do
me.
any other day that week, but not the 18th, unfortunately.
Are we going into the next week?
ATU can't. On the next week, we have that's our charter week. How about the week prior, the week of the 8th? I mean, is there a reason why that week was torpedoed?
I won't be available that week, but it may not matter by then.
Okay.
I can make the 16th work. I think I can move this other meeting I've got. So I can make the 16th work if that's better for everybody.
I mean, yeah, 16 works for me, and better for Michelle.
Right.
Everybody else?
I can make it work.
I can make that
Yeah.
work.
Hey,
Works for me.
Well, thank you for being flexible, Fred. We appreciate that, and we'll mark it down for the August 16th at 11 a.m. start for the ATU LTD Pension Trust, with the salary plan to follow after, which is what you guys will be doing now.
Thank you, Bill.
Okay, Christina, it's yours.
Okay, thank you. All right, we'll start the salary plan meeting, pension trust meeting. We'll start with, I guess, another roll call. So, Mark,
I am still here.
Michelle,
Still here.
awesome. All right, excellent. So I don't have any preliminary remarks. And does anybody have anything that they wanted to add to the agenda? Hearing none, I'll move on. Is there anybody in the audience, Camille?
No.
I'm sorry, what's that? Camille, is there
No, there
anybody
is
in-
not.
Okay, awesome. So we can skip audience participation. And so moving on, approval of the meeting minutes. Does anybody have any changes to the existing meeting minutes? The minutes
I
to the
move
last
approval
meeting?
of the minutes.
Awesome. I will second. All in favor?
Aye.
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 Hi.
Michelle? Awesome. All right. And no one is therefore opposed. And so then we will move on to the report of the investment consultant. I don't think we have any board recommendations for this meeting. So Ian, do you have anything you want to share on the salary plan?
The 3 documents that I shared during ATU are the same 3, obviously updated for salaried. Performance is, we have a slight difference in the asset allocation, but very minimal. So it's within, I think, 10 basis points in performance. I did an asset allocation study. Again, no recommendations. The good thing is here is because our assumed investment return assumption is 5 instead of 5.75, that the current asset allocation mix does give a 50 or greater % chance of achieving that. And the same memo applies. So again, I am happy to run through any of those in more detail if the trustees would like, but if the earlier conversations were sufficient, I don't have anything necessarily more to add to the conversation unless specific details would like to be discussed.
Thank you, Ian, Michelle, or Mark. Is there anything that you would like for Ian to cover? Okay, excellent. So then we will move on. Jeff, Scott, do you have anything that you want to report from the actuary perspective?
Nothing to report today. Thanks.
Excellent. Jeff, do you have anything you want to report from the legal perspective?
No.
All right, excellent. Moving on next to the administrator's report. Sarah, do you want to cover the administrator's report?
Yeah, I just had sent the expenses and retirees since the last meeting. It looks like those were pretty typical, minus the one lump sum payment benefit date effective 2018. That was one of the participants that we did the forced retirement with at the last year when we did all of those. So that was the only oddball one. Everything else is pretty typical. We do need to talk about the cash flow as of April 29th, actually April 30th, the bank account, I believe, has $44,000 in it. And so we need, at this point, we are suggesting a cash flow of $500,000. Dean is saying on or before May 1st, but that's obviously after, on or about May 1st, but, basically as soon as possible, just because with the $44,000, there's not enough to even pay the next month's benefits.
Right. And how long will the 500,000 runway will that give us?
He is stating that the 500,000. Yeah, he said if we could do less if the trustees wanted to make more than one transfer a year, but the 500,000 should allow us to go a year without another unless expenses or retirement payments are unexpectedly high.
Okay.
So it seems like even if there is one more lump sum payment person coming through this year, that might trigger another cash negative.
Okay. All right. So trustees, Mark or Michelle, do you have any questions about that transfer, or are you comfortable with that amount or a different amount?
I'm good with that amount.
Michelle, are you okay with that?
Yes.
Okay, excellent. So do we need to, I guess, probably make a motion to transfer money from the investment account to our regular checking account at Kernet Stokes?
I will make that motion.
I will second that motion.
All right, thank you. All in favor?
Aye.
Aye.
Aye. All right, motion passes. And Sarah, we will we can start working with Ian to make that transfer happen.
So just a quick update, Sarah. 500,000.
Yes.
And as soon as possible.
Yes.
Okay. I will work on that, Christina. I know we've done these in the past, but I will send you over the recommendation and the letter of instruction that you will need to sign to initiate it with the bank.
Sounds good. Thank you for your help with that, Ian.
Of course. And Sarah, I'll copy you on the communication that I sent to Christina so you kind of know where we are in the process.
Perfect.
And Ian, do I need to run that by Michelle and Mark before I sign it, or is it? I thought in the past I just signed it.
Yeah, I believe you're listed as a signer. So as long as Mark and Michelle are okay with that, I think that's been the process.
Okay.
I think we just approved it here, so it should be fine.
Perfect. Thank you. Sarah, is there anything else?
Yeah, no, everything else we kind of covered in the other meeting, minus the fact that I wasn't sure, Christina, if you wanted to talk about making the CAP process certification mandatory, but that's what the ATU members have done, is they've made that CAP certification mandatory. I think years ago when we decided this, we decided that the salaried would just do the continuing education.
Mm-hmm. Well, since all of the trustees that are on the salary plan are also on the ATU plan, I think by definition they'll have to be CAP trained anyways. That I'll leave it up for discussion between Michelle and Mark if they feel that we should have that as a new policy within the salary plan.
And we can always bring
yeah, I mean, it by default will be certified. So I don't know that it's necessary to put it in the plan. I mean, at some point, if the trustees change, then maybe it makes sense.
Sounds good. Thank you.
Other than that, I don't really have anything else.
All right, excellent. I think we already had the discussion about whether we move to just having recorded minutes. Do we want to have, for this meeting, which is, I guess, a much shorter meeting, I don't know if people feel that that would be okay to just have the recorded minutes, or whether or not we actually have to have the written minutes for this meeting.
We could be the beta test for the pension trusts, right? So we could start doing the recorded minutes here and see how they go and see what kind of issues we run into.
I think that's a good idea. And I think if the agenda reflects where we're making decisions, maybe we people can easily see in the agenda if it says decision, trustee decision or something like that, that maybe that will allow people to jump to that spot and know that they can then listen to a piece of the agenda that relates to a decision being made. Michelle, do you have any thoughts as well?
No, that sounds like a great go forward to me.
Okay, excellent. So Camille, we're going to be the test case on the salary plan for having the minutes being just the recording as opposed to written. Do you have any questions or concerns with that?
Perfect.
Okay, excellent.
No, I am keeping the audio record and video recording regardless. It just means that Sarah does not need to do the minutes for this side of the pension trust.
Perfect. That sounds good. And I think the last thing, we already talked about the trustee training, which will be covered in the HU side of the plan. And is there any, I guess our future meeting is on the August 16th, following the HU meeting that starts at 11. Does other than the fact that I know I'm adding an agenda item related to the policy for the board, is there anything else that I need to make sure that we include on the agenda for next time?
If there happens to be after the meeting, everybody can either email myself or Camille.
Say that again, Sarah. What happens after the meeting?
If after the meeting somebody wants to add something to the agenda, they're more than welcome to email myself or Camille. We'll make sure to talk to each other about that.
Excellent. That's great. Thank you for that, Sarah. And does anybody, before we adjourn, does anybody have anything else they wanted to cover at this meeting? No? Well, thank you everybody for being here and for being part of the Salaried Employees Retirement Plan Trustees. And have a good rest of your day. See you,
everybody.
in August, in person.
Bye, guys.
Bye.